recording of transactions involving securities that have been categorized as available for sale. Available for sale is the appropriate classification when we have a company that is not holding securities for trading purposes, that is holding them like inventory that will be eventually sold to a customer, as would be the case for a brokerage firm or other financial service company, but instead as a way to manage excess cash. In exercise 12-7 on page 671, we have a construction company that has excess cash from time to time. Instead of receiving low rates of interest on a savings account, they've decided to invest this money. We're going to begin in 2011, where we will purchase some stock, we'll purchase bonds, we'll have a sale of a security, we'll receive dividends and interest, and then we're going to need to make an adjusting journal entry to record the change in fair value for the securities that are held as of the end of the year. So read through the problem, take a look at the transactions, and we'll prepare the journal entries. We have a partially completed set of journal entries. We've put in the account names, and we're just going to do the measurement for the dollar amount. Remember, when we have investments, when we purchase them, we will set up a separate asset account for each of our investments so we can track them. We will have a revenue account that relates to the investment revenue, dividends, and interest. When we sell securities, we can have gains or losses on those investments. These will be realized gains and losses that will affect the income statement. And when we have available for sale securities, we will have a fair value adjustment account. It will be contra to the group of investment accounts. We don't need to maintain a separate fair value adjustment for each investment we have. We can group them all together and have one fair value adjustment. And we're going to have an effect on other comprehensive income. We can have unrealized losses, OCI, or we can have unrealized gains, OCI. Again, we want to differentiate in the account name that the impact will be on OCI and not on the income statement, on net income. Let's begin on our journal entries, and to keep things simple, I'm going to work in millions. On March 2nd, we have our first investment. We paid $31 million for 1 million shares of platinum. So we're going to increase our investment account by 31, and we're going to reduce down cash for 31. So we have a trade in assets. We have our second purchase in April. We're going to purchase some bonds from Zenith Corporation. These bonds pay 10% interest semi-annually. We're going to pay the face amount of these bonds, and it's going to cost us $20 million in cash. So we reduce down cash, and we debit our investment in Zenith bonds for $20 million. Now we're going to hold these investments, and in July we get our first cash flow from these investments, and that's going to be a cash dividend of $2 million on our platinum stock. So we'll receive a check from the company for $2 million, so we'll increase cash, and at that time we'll recognize investment revenue. Now remember, investment revenue is a temporary account, just like sales revenue, and it needs to be closed out at the end of the year. At the end of the year, it will be carrying a credit balance before closing. So during the closing process, of course, we debit it. On October 15th, we're going to receive an interest payment on the Zenith bonds. The payment is for $1 million, and that represents half a year's interest. So we have 10% bonds. Half of the annual interest on those bonds will amount to $1 million. So we receive a check for $1 million, and we're going to recognize investment revenue of $1 million. So our investment revenue account now has a credit balance of $3 million. After receiving the interest payment, we decide to sell those bonds. We go to the open market, and those bonds are now selling at above the face value. When we sell our bonds, the cash proceeds amount to $21 million. We are now going to zero out the investment in those bonds, and we purchased them for $20 million. So we reduce down the investment account to zero, and the difference between the cash proceeds and the cost of the bonds we recognize as a gain. The gain is separate from investment revenue. It's a separate temporary account. It too needs to be closed out at the end of the year. On November 1st, we're going to make another purchase. We're going to purchase 500,000 shares of LTD stock at a cost of $40 million. So we will increase an investment account by $40 million, and we will reduce down cash by $40 million. Now at the end of the year, we need to make a fair value adjustment for those securities that we still own. We still own the two stocks, Platinum and LTD. We no longer have the Zenith bonds because we sold them the day after the interest payment. We're due no interest on those bonds, so we don't need to accrue any interest. So we're going to go ahead and determine the fair value adjustment for our two investments. We check the market and we see that the Platinum stock is currently selling for $32 a share. We own 1 million shares, so the fair value of that investment is going to be $32 million. We see that the LTD shares are currently selling for $74 per share. We own 500,000 shares, so we're going to take the $74 a share, times it by 500,000, and it comes out to be 0.5 here because we're dealing in millions. So the fair value of our investment in LTD is going to be measured at $37,000. For the Platinum, our fair value was 32, the cost was 31, so we have an unrealized gain of $1 million. For LTD, the fair value is 37, the cost was 40, so we have an unrealized loss of $3 million. And now I'm going to total up our columns, and the net amount we're going to report on the balance sheet for the value of our investments is $69 million. We don't necessarily have to go in and change the balances in these investment accounts. Most firms do not do that. Instead, we're going to use a valuation account called fair value adjustment. The unrealized loss of $2 million will not impact the income statement. Since these are available for sale securities, the effect will be on other comprehensive income. So the bottom line is we have a decrease in the value of the assets that we're going to be reporting, of $2 million, so total assets will be reduced by $2 million. We will not recognize net income, so retained earnings is not affected in the equity section. But we're going to show this $2 million reduction in value of ownership or equity by reporting a $2 million reduction in other comprehensive income. So let's take a look at this journal entry, which is fairly straightforward. The fair value adjustment is to reduce down the overall value of the investment assets, so it's going to be a debit of $2 million. The unrealized losses and other comprehensive income will be $2 million. If we were to do the closing entries, we would need to close out two accounts. We would need to close out this gain on investments. It has a debit balance. So as part of the closing process, we will credit income summary and we'll debit gain on investment. We also have to zero out our investment revenue account. It currently has a $3 million credit balance, so we'll debit investment revenue for $3 million and we will credit income summary. Now for 2012, we're going to sell half of our platinum stock, and it's currently selling at $32 per share. So we own 1 million shares of platinum, so we're going to sell 500,000 at $32 per share. Again, the 0.5 represents half a million. So we're going to receive cash proceeds from the sale for $16 million. We've sold half the share, so we're going to reduce down the cost by half. Our original entry was a debit to the investment of $31 million. We've now sold half, so we're going to reduce down the cost by half, so $15.5 million. The difference between the cash proceeds and the cost is going to be our gain. And this is a realized gain. This will impact the income statement. Next, we're going to sell all of the LTD stock for $76 per share. We had 500,000 shares. So again, we're going to take the price per share, multiply it by half a million, which we represented by 0.5, since we're working in millions, and we will have cash proceeds of $38 million. Our original investment in LTD was $40 million, so we're going to credit it at cost, and the difference will be a debit of $2 million, and that represents a realized loss on the sale of the investments. Since we have sold these securities that we had recognized unrealized gains or losses on in previous periods, sometime during the current period in 2012, we're going to have to reclassify the OCI. To do this, we're going to look at our securities and measure the reclassification. For platinum, we sold half of our shares. We had previously an unrealized gain, OCI, of $1 million. Half of those we no longer own, so our reclassification adjustment will be for 1/2 of the unrealized gain. For LTD, we don't own any of that stock anymore, so we are going to reclassify all of the unrealized $3 million loss. So the net amount will be the positive 0.5 minus 3 for a total reclassification of other comprehensive income of 2.5, and we will reduce down the fair value adjustment by 2.5. So our reclassification entry will reduce down the fair value adjustment by the 2.5 we determined, and we will reverse out the unrealized OCI loss also for 2.5. So after this, we will still have a fair value adjustment of $500,000 relating to the platinum shares and a unrealized loss OCI of 0.5 relating to those platinum shares also. And those are our journal entries under the available for cash method.